Hey everyone, Ismail.Kolya here from Guidance Residential. I want to take a few minutes to educate all of you, especially the first-time home buyers, regarding the criteria and factors that mortgage companies use to qualify for home mortgages. First criteria and factor is your income. How much income do you have, and is that sufficient for you to cover your monthly expenses? For example, someone who makes $60,000 a year, their monthly income would be $5,000. That's $60,000 divided by 12, so that's $5,000. And depending on your credit, anywhere from 41% to 51% of that could be used for housing purposes. So, for example, let's say someone with good credit would be able to use 50% of that of $5,000, so that's $2,500. So income is your first criteria in terms of your eligibility for a home mortgage. Your second criteria is your credit score. So you want to make sure that your credit is good, if not excellent. The better the credit score, the better the rate you will pay, whether it's an interest rate or a profit rate. In the case of Guidance Residential, you're paying a profit rate or a rent rate. So the better the credit score, the better the rate that you'll be paying. Why is that so? Because someone with a better credit score represents a lower risk to the mortgage company. So you want to make sure that you have an excellent credit score. If not, work on improving it and so forth. You'll have a better chance of getting mortgage approval. Third criteria or third factor that you want to focus on is your down payment. With programs around right now, you can put down as little as 3% for single family home and 5% for multifamily home for first time home buyers. So that's the minimum. Obviously, the more you put down, the better chances of your offer being accepted with the seller. And also, there are mortgage insurance that you pay, which goes away if you're putting down 20%. Having said that, if you don't have all the 20%, I don't recommend that you wait until you have the 20%. I recommend that you rather buy today. It is better to pay PMI, the private mortgage insurance, rather than wait until you have all the 20%, because by waiting, you'll be paying a higher house price as well as a higher rate or higher interest rate down the road. So it is not recommended that you wait until you have the full 20%, although if you have the full 20%, it is ideal. And then lastly, your liabilities. You want to make sure your liabilities are as low as possible. These are obligations, or these are bills that you are liable to pay each month. These could include your credit card bills, your car lease or finance, student loans, and so forth. So when you're in the process of buying a house, if you're thinking of buying a house, it is best to make sure that your liabilities are at a minimal. If you need a car, make sure it is an affordable car and it is well within your means. Also, pay off any credit card balances that you may have so that your chances of mortgage approval are maximized. If you have any questions, reach out to me, 914-215-1540, 914-215-1540, so we can get on the phone and discuss your individual circumstances and see if you're ready to buy now. And even if you're not, we can set a plan of action in motion to get you ready in the next 6 to 12 months. Again, 914-215-1540. Ismail.Kolya from Guidance Residential. Thank you for watching.